I come from the stable of be first, be different, don't be better. Better mousetrap, who cares? I think if you be the first at doing something, or you can be radically different and transform, do something in a way that's transformative, then you've got a real chance, I think. But if you're a better version of vanilla ice cream, I mean, you're in the so what territory.
Welcome to Startups Decoded, where we uncover what it really takes to build and scale startups. I'm Andy Walsh, founder and strategist. Each week we will bring you actionable insights and real stories. Let's dive in. Hello and welcome back to Startups Decoded. Today our main topic is founder and investor fit, and in 2025 that topic has never been more topical, in lack of a better term. And to welcome today a special guest in Chris Tottman from Notion Capital. Welcome, Chris.
Hey, it's good to be here. How are you?
Yeah, good. Very good. We've been flirting with this conversation for a little while, and I'm glad we got it booked in. And we were just chatting before the show. You're a man who doesn't like to do meetings, which I've got a lot of respect for. So to get some time, I feel like I'm one of the lucky few.
Yeah, I am. I'm very anti-meeting, which is why I get to chair quite a few meetings, because they know you're either contributing to the meeting or you're extracting value from the meeting. But if you're doing neither, why on earth are you in the meeting? Because they're just so expensive. When I imagine all of the people zooming into somewhere, maybe sitting there in their pajamas with a business shirt on top. And yeah, I mean, I just think it's just an incredible waste for entrepreneurial businesses when it's kind of meeting overload. So I kind of made the decision to be anti-meeting about 7-8 years ago. So Monday and Tuesday are back to back, but Wednesday, Thursday and Friday are left pretty open.
It's the way it should be too. And I think the remote work culture, and it's not our topic today, but just quickly, I think the remote work culture has demonstrated that we don't need to be around each other all the time. But I think meeting cadence has been a bit of a victim of that. It's too much. And I've gone from 45 minutes to 30 to 15 minutes with meetings. And I get through all the things I need to because everyone has an urgency to focus on the main things.
Yeah, I think that's right.
Anyway, we're not here to talk about meetings, not very sexy. So, Chris, the topic today around founder investor fit is pretty broad. And as I said up at the start, the relationship that a founder has with an investor can be different depending whether you're coming in early as an angel or going late at Series C, Series D. If you get a board seat, there's a lot of things that go behind that. But just help folks understand a little bit as far as your background. I'm always curious on where you came from in the sense of your path into venture and what led you on the start of your journey.
Yeah, well, I entered in the old-fashioned way. In 2008, we had a particularly big exit. We'd ridden the wave where we'd all connected to the internet in the late 90s, and so everyone, for the first time, became vulnerable to email-borne viruses, so malware hidden in spam and email. And we built a security proposition to solve that problem. We had an ISP, so like a CLEC in the US that was connecting companies to the internet. And that gave us the opportunity to find this vulnerability. And that became the first really, really big European SaaS business in generation one of SaaS. So from 2000 to 2008, we went from 0 to 150 million of subscription revenue. And we sold that. And what was very typical of us, we announced Notion the day after the acquisition was announced, obviously pissing everybody off in the transaction. But we thought, hey, we can't miss this PR wave. So we sold the company. We had 50% of the cap table. So, we had a lot of money to deploy. B2B SaaS was like 1% of B2B IT spend, So from a thesis perspective, we thought that it would be like 50% in our lifetime. So you've got this situation where you've got like hundreds and hundreds of millions of dollars being spent with hardware, software, and system integrators, i.e. in the wrong place. And we saw that transitioning to these completely new vendors that were built, predominantly from conception on the cloud. And so that was the thesis at the time. And we wanted to ride that wave. So we Fund One was $30 million of our own money. And so we bought our way in, And, with a view to raise money from LPs. So we're now deploying our 8th fund. So we have 5 venture funds, 3 opportunities funds. And so, we invest over the whole life cycle to kind of Series B, Series C. So we can angel co-invest. We do a lot of discovery deals, before product market fit or things that are really binary. They're either going to work or they're not. You either make some money or you lose it all. Typically, the majority, our flagship fund is investing at Series A and Series B. So that's, where we predominantly focus our resources. But today, for the last 12 months, we've probably invested in a deal every single week, but those will be predominantly those angel co-invest deals that we do super early on. It's been an incredible ride for the last 16 years.
It seems to be really common, and there's a lot of solo funds that are opening up in the last 12 months. A lot of people doing that are exited founders. And candidly, do you think to be a good VC that you need to be a founder first?
Statistically, definitely not. The makeup in the US vis-a-vis, the percentage of check writing VC, so partners that are really writing the checks, is more like 60 to 70% are ex-founder operators, with the rest pretty much coming from, Big Four consulting, banking, M&A backgrounds. Whereas in Europe, I haven't looked at the stats recently, but it'd be below 15% were founder operators that have created their own fund. It just takes time to sort of figure out that balance. And, I've worked with VCs that are extraordinary from both camps. So I think founders just have to be just really diligent about who they want to have around the table, and the reasons, be intentional about the reasons why they want those individuals more than those firms, to be honest. It's a marriage. I think I have a phrase which is like the 2 biggest things of wealth creation and wealth destruction is your life partner and your business partner. And the VC that you have around the table is going to be one of those business partners. So, you really want to get into bed with them, or you don't, so, and sometimes there's a lack of optionality and you've got to maybe take the right offer for you at that point in time. But I don't think the data suggests that the bankers can't fundamentally outperform the founders and the operators. I don't think that stands out. I mean, they're just extraordinary investors that founders can tap into.
Yeah. And I don't want that to come across as me saying that if you're a VC and haven't been a founder, you won't succeed. It's just a topical question at the moment. I ask everyone the same question because I think it's really interesting on the shift that we're seeing, and to set up a good foundation for today in our conversation and that collaboration. And not all investors are built the same, and you could invest even at a late stage with a startup and not play a functional role as far as a board seat or contributing. It could just be a follow-on investment, supporting a lead investor who has a board seat, etc. So those dynamics are very different. For Notion Capital, do you have a rule within your thesis as far as, do you do lead investments only at that later stage? Are you doing follow-on? How do you operate in that sense of, 1, the investment, but 2, how you work with those founders ongoing?
Yeah, and that's a good point. I mean, as from a firm, it's quite easy to kind of figure out the sorts of things that we like to invest in, how we invest, where we invest. So we're a European wide fund. So typically 90% of everything we invest in is going to be a European headquartered business. Many in the early stage flip to the US because, let's say, they've joined Speedrun, A16Z, or they've joined Y Combinator. So they typically have their corporate structure moved to the US. That irrelevant of that, we would still invest in those businesses. It's always about something that's transforming a business. So we don't do any consumer investments, and we're very interested in the revenue model. Because we have this SaaS heritage, then we're very, very interested in what we would classify as like repeat, recurring, reoccurring types of revenue models where there's high levels of consumption, there's high margin. And, the less known in the market, consumption-based pricing is the most typical now, rather than, let's say, seat pricing that you would have got 15 years ago. And so you'd see our strategy where that technology is transforming business could be almost within, a factory or in hardware, not purely in software. So software just becomes a very important part of the overall value proposition to the buyer, but it isn't necessarily that the only thing we're investing. For example, we're invested in a drones business in Germany called Quantum Systems, and 10 years ago that would have been unlikely. Today, it's very typical. We've invested in a highly automated factory, for example, which think of it as like an entire vertical stack. It just happens to be, a factory. And so the opportunities for that from a margin perspective and also from a technology perspective to be repurposed for other ways is, extremely exciting.
Yeah, the interesting thing that I've seen is businesses that through the shift in AI are able to multiply and scale at a rate they weren't previously able to do. And investors investing in companies that they typically wouldn't look at. And I was chatting to Mike McCombie on a previous episode, and he's a solo GP, and he's invested in a lot of those infrastructure-based companies where they can see huge opportunity to be first to market, to beat competitors who are still operating like it's the 1990s. And I'm fascinated by that. And even business marketplaces of people that have existing businesses that are selling them for cheap because they want to retire, don't know how to adapt and change. It's fascinating to see that happen alongside brand new businesses that are leveraging AI in ways that we haven't seen before.
Yeah, I think that's right. I mean, just like politically minded people live in a bubble that doesn't really impact many people on the streets. It's the same with the technology world. We live in this bubble where we think, oh, there's this app that's going crazy where it's a new way of doing something that everyone's been frustrated with before. Let's say, prompting the ability to create a website, and all of a sudden there's this just incredible hype and level of unmet demand on using something that's extraordinary in historical terms, like the Lovable app, for example, for creating websites or apps. And you just start to mop up huge amounts of that latent demand. And a lot of the app AI companies, obviously, we love the application layer. That's typically where the majority of our investments would go, is that you get a huge amount of demand, but then you get low utilization or low usage, and sometimes you get quite a high degree of churn. And so you'll see quite a lot of AI investments that that hyped up and then they hype down. And so sorry about that. So, but yeah, I mean, we're just in this extraordinary era today where the tools available to people are just incredible compared to the tools that we were using before. And so you are going to see these kind of extreme hype cycles. Also, you're going to see obsolescence happen much quicker, right? So something's going to go hot and that's going to make a whole bunch of other vendors obsolete, but it's also going to mean that the cycle is going to be that much faster. For example, in a venture fund, you might think of it as a 10 plus 12, but if you look at the averages, whether it's European, B2B, or the averages, it sometimes takes 15, 16 years to fully realize that fund. I mean, in an AI world, you think you might be able to go through 2 or 3 cycles in 15 years. So I think it's just such an exciting time at the moment. The VC model is quite straightforward. There's source, select, and support. The game is really changing on the source side, right? Some things that you may have been excited about a year ago, you just can't get excited about today. You've got this new cohort of companies that are growing extraordinarily fast, unprecedented levels of scale, like OpenAI's level of scale within the time period that it's happened. Obviously, there was a very, very long layup for a period of time, which is common with deeper tech. And just like you may have got with crypto investors, 3 or 4 years ago, where it hyped up and then came down. We'll see a little bit of that in the AI world. But take the 90s. I would have seen a pitch at the time, which is my IP-enabled fridge that would replace the milk when it was running low. I'm not sure I needed that. I'm not sure I could even buy it today, 25 years later. So there was this huge hype of companies that were selling stuff on this thing called the internet, and you wouldn't have said that the guy that put books to be sold online was going to become the titan for the next 25 years, right? And there's Amazon to a T. So I think a lot of us think we know what's hot and what's not, but history tells us that no one really knows what's going to ultimately be hot over a longer period of time and what's not. We just know that it's going to be like 2% get to the other side, 98% don't. And in that 2%, there's a very, very small percentage, which is where, the people of the future these are the things, the rails that trade is happening on, that your life is happening on, that your communications are happening on, right? These are the people that fundamentally kind of own that space. And there's just going to be some, particularly now, I think there's going to be some just iconic companies that are created over the next few years. So it's a great time for founders. It's a great time for venture.
I think you'll appreciate this. If you didn't see it on LinkedIn, just the other day, someone posted about an interaction that happened between a founder and a VC, and this person knew both sides independently. And it was someone who had basically created a product using AI, created a pitch deck using AI, engaged an investor using AI. The investor then used AI to assess the founder, their business, all the numbers, and was making decisions. So basically, you've got a whole bunch of code ultimately that's creating, engaging, and making final decisions. And then the people meet, and everything else has been alley-oop for them to a certain degree. And that's a perfect example of the world that we live in today.
But we can have source, select, and the support. We just get it all done by our agentic agents, right?
We all need multiple versions of ourselves, which is ultimately where we're going. But to look at that, once you get into the past the source and select phase, the service piece is really interesting. And like we set up from the start, look, that relationship from how you start to engage an investor to how you collaborate is something that you're passionate about. And to set the scene for people, on our last call, we had a really interesting conversation about you as far as how you see the world, how you communicate, etc. And you're very candid with me. And I think that feels like it's very important to how you operate today. And I'd love for you to set up your backstory.
Well, yeah, I think your question when you first sent it over to me was like, when did you first figure out that you were weird? Which is,
It wasn't that blunt.
I love that question. I think it's great. For all the weird people out there, there's quite a lot of kinship. So yeah, I mean, I've got a dyslexic profile, and thankfully for me, it's a dyslexic profile that I really love. I think I first knew that I was wired a little bit differently, probably in my early 20s. And, I would have big jobs and I would give them up to go back to the beginning. So like I left Lehman Brothers in my early 20s and went to a sales boot camp for 2 years to try and figure out, how do I understand what I thought at the time was like the money tree or the money orchard, or the owner of all the money orchards in the world, right? It's like, okay, if you can understand how the money tree, and I come from a really working class background. And so then if you were into meritocracy, you would think, one of the highest ROI skills is selling, much like pitching is, and selling today, it would be deemed. And so I knew investment banking or trade, I was in the trading side, wasn't going to work for me. It just didn't feel right. And if meritocracy was generally something that I was really ruminating on at the time, that felt like the right course of action. My parents were horrified, of course, and all my friends were mystified. So I did a 2-year boot camp in sales, which was really, really tough. And then I did a 6-month boot camp in marketing, which is much easier because it's kind of brain work. Whereas sales kind of zips you open and all your inhibitions fall out, and you have to kind of piece yourself back together again. And so that was a really unusual move. This is a very non-typical contrarian type move. It could be a stupid move, but something that was really important. And I started to found companies, and we had a coach who we called the evil coach because he used psychological techniques that we felt were morally ambiguous. Hence why we called him the evil coach. But we knew that. We hired him anyway because it was like meeting someone that was from the dark arts, like a Sith. And we started to learn about neurolinguistic programming. And it was the first time I realized that other people could think in color. So I can only think in black and white, which is like the first time I realized that, that's really, everyone was like, that's weird. So that was probably the first time. And then my son needed to get tested for dyslexia. And then his score came out in terms of his short-term memory recall was almost non-existent. It's just, normally it's 40 and he was 4. So, and I just realized that was me. It was right there in the conversation, in the test results. And so, but I think of, so like you said, became really passionate about people in this period because I was building very, very large go-to-market teams. And in order to do that, you have to understand motivations of people, their relationship between, the inputs of what they need to do and the outputs that need to happen to come out. You need to think about how you get team structures right, how people form together, how you take people through huge stages of transformation. For example, a listed business on the FTSE or the S&P might grow at 7%, and much of that growth won't be organic. A startup would need to be growing from zero. It would need to grow infinitely at the beginning, but then it would need to triple, double, or whatever, model anyone might like. But the fact is the conditions of that business are extraordinarily different compared to, the largest listed businesses in the world. It's just not the same sport. And you have to be really, really interested in, psychology, people, the combinations of people is where I got very fascinated. And so I think, my dyslexia, my energy, and my ruminating on ideas and experiments, all of those things have kind of fueled me in terms of the sort of like unusual edge case skill sets that I've got today. It's 20, 30 years worth of work going through this non-linear path that I've gone through.
It's become, again, something that people are much more aware of, which is really healthy. And even myself, my wife has ADHD, and it was a diagnosis that was probably formalized 2 years ago, but there were definitely patterns previous to that. And just understanding dopamine by itself, as far as she has to hit a certain threshold before it even acknowledges it's something that she needs to do. And that used to cause some tension in the household where stuff just wouldn't happen. And so for me, my personal journey was learning how to understand. So it becomes down to communication and to your point. And I think that what you're saying there, the ability to look at things in a way through your own lens, sometimes that can be a virtue and other times it can be problematic as well. But that understanding is critical. So for you with your portfolio, I think you got over $1 billion AUM, right? Under Notion?
Yeah, that's right. Yeah.
Yes. So you've got a large portfolio and you can't talk to everyone. I've talked previously about VC platform on another episode with Blackbird, but I'm curious as far as your passion and energy to collaborate and fill your dopamine. How do you start to double down on different people when your portfolio is so big?
That's a really good question. I mean, it's hard to do, I think, but we wanted to be the investors that we didn't think that we had. We actually had some pretty good investors. They're mostly on the banking side, but that was pretty typical in the late 90s. And so one of the core tenets of us being successful is the ability to be empathetic to founders and to be value added. VC firms are a collection of wolves. And so it's like, well, how does this scale? It's like, I don't believe I'm a specialist in anything, and I think I'm a generalist, but I don't want to be the expert in anything particular because of the way that I am philosophically and the advantages that I've got. And so as a company, if you're going to have a value added part of the value proposition, then you've got to think about how do you build infrastructure to create value add, to deliver value add for, many of the big challenges on the heat map that founders go through, whether that's product market fit, whether that's product packaging, pricing, monetization, whether that's go to market, whether that's hiring. The list is endless. If you could cookie cut this thing, then, there'd be 9 billion billionaires, right? So in 2012, we just decided that we were going to invest in a value-added infrastructure. And so because I'm more of the sort of experimental one, I stupidly put my hand up for that. And I'd been experimenting on a bunch of things. Anyway, I've always got like a dozen experiments that I'm running in the background at any one given time. And so, we started to sort of peel back kind of what are the key pieces that founders desperately need. And there's the kind of utility layer, which you can get for free on the internet, right? But you might need to create, a depository or a library or some things of that. And then that would have been written and now it would be in video form. But some of the big things are just the kind of big decisions that people need to figure out. Like, who's the customer that I'm serving? How do I understand product pricing and messaging? What is my value proposition? Should I be broad or narrow? Am I a brand business or am I a data business? Am I both? Am I building my architecture in an open format so that I can become a platform. These are the sorts of things. So ultimately where we went is we accumulated a huge amount of practitioners who really focused in these areas, and we just kind of make them available. Every year we take a pretty nice hotel. The budget's always broken. And, we have 100 of our founders as some of the great world experts turn up, and they're there for, 4 or 5 days at our expense. And, this is like, this is the big tent. This is, facilitating like a big conversation of what is the things that the founders genuinely is really vexing them at that point in time. We've been through the lockdown. You mentioned earlier the whole remote work. Lots of founders want people close to them. There are others who are like, no, I want to be fully remote. Today there'll be disruption around Gen AI and how they're utilizing AI either internally or within their products and so on and so forth. And those are probably the 5 most important value added days of our year. And founders love it. I mean, they just rave about it. But we spend maybe $1 to $1.4 million a year on value added infrastructure for our portfolio. And because we're in the life cycle, the problems or the challenges at pre-seed and seed are significantly different. But I never believe that I have the answer. I always believe that I need to understand what the questions are being asked, to prioritize them like a Boston model, or, what is the biggest payoff, and then think about, well, who are the people that we need to make available that can give us some kind of advantage for our founders. So that's the way we kind of think about it. I think it's narcissistic to think that you can sit around a table and the challenges that come up are going to be in your heat map, right? Of, where you've got a really edge level of competency. And so once you've made that conclusion, you understand that actually it's an infrastructure game. You've really got to build partnerships, collaborate, work with other people, and make available these resources to your founders and their team. So
first and foremost, I'm not sure when your next retreat is, but I'm going to nominate myself to be your MC and host for that event so I can come along and ride the coattails. So just put that one down. I'm self-nominating.
When marketing people are really good at getting budget, they'll say, well, the budget now is going to be, and it's like an eye-watering number, and then everyone pushes back and they go, well, we could go to a cheaper hotel. Or, no, okay, we'll do that. That's okay.
So let's talk about that one after the show. I won't do my pitch to you right now, but to pick up though on some of the things that you were saying there, I think it makes a lot of sense. And I would go as far as, and I've said it before, that I have a framework that I use for my portfolio, advisor roles, angel roles, etc. And I would say that 70% of things that you do in a startup are repeatable. And that could be from workflows, saving files, marketing. There's just things that are standardized. And you need to, particularly today, stay up to date as far as moving from a manual process to an automated process and what that looks like and the trade-offs. But I think as far as how you're thinking about those bigger questions, which is what you called out there, like if a founder can't solve a problem of how they do an email database and do email distribution, then I don't think they're going to succeed as a founder and with their business, right? So there's things that you can find easily and solve yourself. They should be coming to you with the big problems where it's, we know what we know and we now know what we don't know. We need to be able to get a round table here to be able to think about scenario planning and making a decision of how we move forward. And it sounds like that's how you're operating, where things float to the top that aren't just solvable immediately, and getting an external point of view can be really empowering for them to move forward.
Yeah, I think that's right. I think we have this phrase, which is like, we don't want to be concerned about you solving the problems that have been solved many times before. But for many founders, this will be the first time they're solving that problem. So you need to be aware of that. The founders that like really go on to big things is they're solving problems that no one's ever solved before, and they solve them. And so when you Venn diagram those two things, there's an overlap where there's kind of somewhere in between, right? And I think, that's the way that I would kind of think about the problems that founders have. Problems that have been routinely solved many times over, but still need to get solved in this new, chart. So an infant-like company, right? It's just forming. And there are problems that are needing to get solved that have never been solved before. And there's some that, is maybe somewhere in between. And, you just have to build your infrastructure and your support around those things, I think.
Yeah, and that tension between intuition and data, you can lean either way. Some people like to float in the middle and use a bit of gut and brain. Others go completely emotions and like, no, this is my baby. I'm making this decision. I don't care what information you have type mentality. And sometimes that can be amazingly successful, but then it can go the other way pretty easily too.
Yeah, I think that's fine. I think the biggest problem is that, like, the great things die in committee. So whether it's data or intuition, normally the great stuff will get lost, with in committee. I mean, I see it. I kind of see it all the time. I think you need a healthy dose of both. And there are people that are predisposed to make decisions based, solely on data, and there are some people solely on intuition. Obviously, I think a mix is much better, but not a mix that's a committee. I mean, ultimately, someone needs to kind of drive momentum, drive things forward, and pace is normally the biggest issues. The company's not executing successfully fast enough. Executing successfully slow enough, or slower, can create a good business, but it might not create a great business from a venture perspective. And there's always a tension between those. Um, but yeah, I mean, we talked on the call before. It's like, I'm a divergent thinker, so I randomly generate ideas naturally. um, but I much prefer that they're randomly generated based on data. And so I think it's brilliant if you meet a highly intuitive decision making person or founder. If they're equally obsessed about the data, I kind of prefer that mix.
I'm the same, and I encourage anyone that I know to probably use data as a foundational framework. Like, here's what we know, and sort of stress test that a little bit, and then try and use a bit of intuition. But I've dealt with founders who you try and push back on what they tell you to be true, even though they've got zero experience. They don't like that very much. And like, there's a level of ego and boldness that you need, but trying to have the right people, I think, is good. But to your point, like, I think that one piece of advice, too many people around the table will create decision fatigue. You need to be quick to identify the problem or the decision and look at information and then make a quick decision and accept the outcome of that. And it's something that I've seen break startups before, where there's too many people, too slow to make decisions, don't really ultimately make a decision, and then just end up being vanilla everywhere.
I mean, I come from the stable of be first, be different, don't be better. You know, um, a better mousetrap. Who cares? You know, um, it, you know. I think if you can be the first at doing something, or you can be different, role radically different, and transform. Do something in a way that's transformative. Then you've got a real chance, I think. Um, but if you're a better version of vanilla ice cream, I mean, you're in the so what territory, right?
And you see it a lot, and you go to any supermarket, and there's probably about 17 different choices for the same product. How do you make a decision? And that's brand and marketing, of course, but there's no real differentiation within that. Maybe quality, a little bit of taste, but I think that what you're saying rings true for me, in that being different gives you talkability.
Yeah, yeah.
I'm excited to have a look at this. You've written a book called Brain Dump, which is coming out in June. Tell us a little bit about that.
Oh, this is a good story. It is a book, so it should be a good story, right? So, I wrote a book with two other co-authors that were my first ever co-founders, about 3 years ago, 2.5 years ago, called the Go-to-Market Handbook for SaaS Leaders. And one of us is like loves writing, you know, and every day, every week, you see founders and you see the common problems. Like, they bounce off VCs because they don't understand like how to deliver a pitch, which would be an investment proposition rather than talking about their product, for example. You see the same issues in terms of like how to get to product market fit or how to create highly repeatable scale. The classic is like the engineer founder that's on his third sales hire. but they were really good in the interview. So when you're seeing hundreds of companies, each quarter, you just see the same comment. So he said, right, I'm going to write it all down. And I didn't believe him. I was like, yeah, okay, yeah, go, just permission based chat. Yeah, that sounds great. Thinking that's not going to happen. Anyway, about 2 weeks later, he delivered the introduction and the first chapter. And I was like, this is fantastic. This is brilliant. So the three of us worked on this book, and then we launched that. And then I retired from LinkedIn, and they asked me to unretire myself, come out of retirement and go back on LinkedIn. So I was really obsessed with infographics at the time, because infographics basically can take a complex concept and simplify it. It forces you to simplify it. And again, I like bullet points. I like to consume through bullet points, which is why the chat GPT here is great for me, which is summarize this book in 10 points or something. So, or perplexity or whatever. So, and my daughter, who runs inbound demand for Snowflake in EMEA, she's quite corporate and I'm not. I want to work with increasingly smaller companies, but make them big, whereas she likes to work in a corporate. So we ideated around what would be this approach online. Anyway, we conceived the BrainDumps. And so they're fundamentally infographics that take complex situations and simplify them. And they're about over 200, out in the wild now. I deliver about 100 million impressions on LinkedIn a year. That's my kind of annualized run rate at the moment. And then that took me towards Substack as a newsletter. So I have a Substack newsletter called TheFoundersCorner, which has about 200,000 readers, about 30,000 subscribers and stuff like that. So what came round again is like, what would book two be? And so Richard, the co-author, the one that loves writing, said, look, I really, really want to write the book of BrainDumps. And obviously you need to create a story narrative around, like, how does it all fit together? And so again, the first book was a workbook. You can pick it up, you can work on a problem within your business that's relatively specific, like pricing, packaging, monetization, and you can fill out the sheets, right? And so what we found is that after about a year, people would then start ringing up and say, hey, I bought your book. I bought my team the book. We've worked through it. It's fantastic. We're stuck on chapter 7. Can you help us? Like they needed an expert. They needed a practitioner to maybe get them out of committee mode. And so with the BrainDumps, we've done a very, very similar thing. So, it's like, how to grow, how to run, or how to raise capital for your technology business. It focuses on 70 different concepts that fit within that. And we're adjacent. So we're working on this now. It is a live to the public, but it's slightly in stealth. Is an online academy to sort of solve that second phase problem where people are stuck, right? And so we're building huge amounts of like online learning. We're assembling experts that can do things like HR for startups, which is very different from HR in corporates, and so on and so forth. So yeah, so the book will be out in about the last month of a book never ends, but in probably 6 to 8 weeks. And it weighs a kilo. That was one of the first interesting challenges. It's like, hey, is the postage going to be more than the book? And yeah, we're really excited about it. And I create and distribute a huge amount of content. I work and collaborate with many, many creators. It's one of the biggest joys of my life is working with other creators for a whole host of reasons that we can get into. And the book is just a really, really nice physical manifestation. And like we say, people tend to use them like they're designed as a workbook that you can pick it up, you can understand the concept, it's simplified, you can write notes on the page, you can hit now a QR code, you can go and get videos on it. And so, we're going to be really excited about when it goes live.
So good. And we'll, of course, share details where you can get hold of that book in show notes. I love looking inside people's brains, and it feels like that's what we're getting, is a little bit of a peek of how you think, how you externalize. Is everything going to be in black and white just to stay true to your thinking process?
No, I've got a really good creative team. I'll send you some early versions of the front page. I mean, they're so great. It's great. I love it. I mean, I said that I'd quite like a brain character and a poo character, just because I think that's quite mischievous and that's quite a lot of fun. But let's. So
So good. All right. Well, I can't wait to have a look at that. Moving on, I know that people would be genuinely interested to hear how you think about your deal flow, what you're looking at, the things that people have done historically to get your attention. And basically what you said before, I think you said you were doing a deal a week. So 50 deals a year is a lot. As far as all the VCs I've interviewed and talked to, some are only doing one a quarter as far as their investment. So you've obviously got a lot of deal flow, a lot of analysis. What recommendations can you give to founders who are looking to get in touch with yourself?
Well, I think the first thing is there's some elements of deal flow that is very unsophisticated. It's a people-based business. People are out in the field, and we would have talked about in the old days building go-to-market teams. They're at conferences, they're at events, they're on a panel, they're speaking. And then there's more digital or more sophisticated ways of sourcing. So we obviously have a machine-driven sourcing capability, which we call Rista. And so that is us building autonomously data sets and scoring situations that happen. For example, I think an insight that I will share that is quite common with VCs is, for example, the co-founder fit would be important. I know people get frustrated with the common language that VCs feel less comfortable with solo founders. Our statistics would say, that you've got, solo founders might be marked down and 5 founders might be marked down, but, 2 to 3 is, statistically significant indicator that it might be more successful. So I think then it becomes like when you're actually talking to a founder, you really want to understand why that relationship exists. Like, why are they together within that mission? Like, what is it that makes them from maybe a founder problem fit perspective that, are these the 2 or 3 or 1 person that's like, if anyone's going to solve this on this planet, it's them. It feels like they're made for this problem, right? So there are kind of things like that in the early stages when there's much less data, the things that you think about as being analyzed on our side of the table. I think another one, would be like, who are the other people? And this gets into the social proof era. So all of these areas can be debunked. Some of my favorite things that have built my career have been debunked, right? Like the math of my career has been designed around Price's law, for example, which has been debunked many times, but it's hard to argue with me against it. And we won't get into it now, but you've got the co-founder founder fit, you've got the problem market founder fit, and those things we tend to treat as being like super important. And then the social proof bit might be, okay, who else has invested in this business? And there is some statistical evidence, which is statistically significant, that suggests that, there is a sort of almost like a gold stream of, angels that are super angels, which would, for me, come back to Price's law. We're monitoring about 1,500 angels, for example, that are investing. But the smaller list, might be those that have got a more statistical evidence that they hit winners, might be, 100, for example. And so if those angels are on your cap table, all VCs algos will start pinging. He's like, how did we get inbound lead? How did we get that inbound call? And it's quite spooky. I've got a founder that I know extremely well, and this is his second time. And I knew him anyway, and we'd go for coffee, and he was in our data set. So our data set would ping, and Index turned up out of the blue. One of the oldest, most senior partners, as in well respected, made the personal call and said, I want to give you $10 million. And that was because someone else joined the company. So it was the someone else, there was this mathematical thing. I think there was an angel as well that would have got a score. So what's enshrined in the data models is also the things that the humans are thinking about when they're kind of in the room, right? So they're not completely divorced. Now, obviously, there's a physical experience in the room, but like, how does a founder genuinely make you feel when they're, describing their business, when they're pitching the investment proposition, when they make you understand the market? But there are also these other design factors that you can kind of think about who you have around the table as a founder, who you co-found with, the problems that you solve, the people that you hire. These we believe have a kind of a material impact on your odds of success. And it's not the odds of success of whether you can have a successful business. it's the odds of success from our side, whether you can have a very successful venture business. For example, Y Combinator, I think if I've got this right, their 2012 cohort had 282 companies in their 2012 cohort. They made 80% of their money off two, right? That doesn't mean that 280 weren't successful, right? It just, the mathematics in venture capital is just more extreme in terms of how does our model work? How does the model of venture capital work? And it works because of a power curve that, drives disproportionate amount of money to a particular company at a particular period in time that enables it to have huge amounts of market power and therefore create more economic wealth, not just for the founders, but for the investors and, probably for a number of the staff that are working in the company. That doesn't mean that all the others aren't successful. It does mean that many die companies. And interestingly, quite often the VC with the highest death rate is also the most successful because they're predisposed to take more risk. And when that pays off, it pays off bigger. So, but I come back to the thing that I said at the beginning is that you've got to have the people around the table that you fundamentally believe are going to enable you to build the most extraordinary company, over a period of time. And what, founders should be quite deliberate about, who they have around the table.
It's for me, it goes back to the start of the two relationships that are going to be the most rewarding, but the most intense is your life partner and your business partner, which is what you set up at the start. It's a marriage in a very different kind of way.
Yeah, I know. I've got my entrepreneurial friends that are on their fourth marriage, a bit like, a Hollywood icon. They have to. I think Pacquiao today just announced that he's going to fight again. He's in his 50s. I'm assuming that's because he's run out of money. Maybe he's got divorced. I don't know, but he did run for president. That's quite expensive. So, yeah, I think choosing your right life partner and choosing your right business partners is definitely either an extremely good decision or an extremely bad decision.
Chris, it's been such a treat to get your time today. Really enjoyed our conversation. There's a lot of information there that for me is valuable. I think you gave us a real peek behind the curtain on some things too, which is great. But just remind folks, Brain Dump is out in June. We'll put the date and we'll talk about that on socials as well. Follow Chris on LinkedIn. His infographics are amazing and he's got super engagement, and I've met some cool people outside of Chris just through his community on theirs. Very worthwhile. Chris, thanks again.
Hey, listen, it's been a blast. The time has flown by, which is always a good sign. And thanks a lot, Andy. I really appreciate it. I love the work that you do. I love the podcast. So thank you very much. And thanks to the audience.
Thank you, Chris. You're listening to Startups Decoded. My name is Andy Walsh. We're back every week. Share with your friends. High ratings allows us to keep going. We love what we're doing, so please support where you can.